Preparing for a Treasury Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a Treasury Analyst do, and why is the role important? A Treasury Analyst helps ensure the company has the right cash in the right currency at the right time. In practice, I would monitor daily cash positions, forecast liquidity needs, support funding decisions, manage bank relationships, track debt and investments, and help control payment risk. The role sits between accounting, finance, operations, and banking, so accuracy, timing, and communication are just as important as analysis. While answering, focus on liquidity management, cash visibility, funding support, risk control, bank relationships, and how Treasury protects the company's ability to meet obligations and deploy capital efficiently. Question 2. How would you prepare a cash flow forecast? I would start with opening cash by bank account, then build expected inflows and outflows over the forecast period. Inflows might include customer collections, intercompany receipts, interest income, or asset sales. Outflows include payroll, vendor payments, taxes, debt service, CapEx, and dividends. I would validate assumptions with AR, AP, FP&A, and operations, then compare actuals versus forecast regularly to improve accuracy and flag liquidity gaps early. Make sure to cover starting cash, expected receipts, scheduled payments, debt service, payroll, taxes, seasonality, business inputs, forecast horizon, variance tracking, and continuous refinement using actual results. Question 3. What is the difference between cash flow and profit? Profit is based on accounting recognition, while cash flow reflects actual cash moving in and out of the business. A company can be profitable but cash constrained if customers pay slowly, inventory builds, or large CapEx is required. Likewise, non-cash expenses like depreciation reduce profit but do not immediately reduce cash. As a Treasury Analyst, I care about both, but liquidity determines whether the company can pay employees, suppliers, lenders, and investors on time. In your answer, talk about accrual accounting versus actual cash movement, timing differences, non-cash items, working capital, capital expenditure, and why Treasury focuses heavily on liquidity. Question 4. How do you calculate and interpret the cash conversion cycle? The cash conversion cycle measures how long cash is tied up in operations. The formula is days inventory outstanding plus days sales outstanding minus days payable outstanding. For example, if inventory takes 50 days to sell, customers pay in 40 days, and suppliers are paid in 30 days, the cycle is 60 days. A shorter cycle means cash comes back faster, reducing borrowing needs and improving liquidity flexibility. Be sure to mention days sales outstanding, days inventory outstanding, days payable outstanding, the formula, operational interpretation, and how a shorter cycle improves liquidity and reduces external financing needs. Question 5. What steps would you take to manage a short-term cash shortfall? First, I would validate the shortfall by reviewing bank balances, forecast assumptions, and upcoming payment commitments. Then, I would prioritize essential outflows, such as payroll, taxes, and debt service. On the inflow side, I would coordinate with collections to accelerate receipts or confirm large customer payments. If needed, I would evaluate drawing on a revolver, moving cash from other entities, delaying discretionary payments, or escalating to leadership with clear timing and options. While answering, focus on confirming the forecast, prioritizing critical payments, accelerating collections, delaying discretionary outflows, using credit facilities, communicating early, and avoiding surprises for senior finance leadership. Question 6. How would you perform a daily cash positioning process? Daily cash positioning starts with pulling bank balances across all accounts, usually through a treasury management system, bank portal, or prior day statements. I would reconcile expected receipts and payments, identify unusual items, and determine whether accounts need funding or sweeping. If balances are excess, I would consider investment or debt paydown options. The output should be a clear cash position report that supports payment approvals, liquidity decisions, and management visibility. Make sure to cover bank balance retrieval, prior day and intraday reporting, expected transactions, account concentration, funding decisions, exception review, documentation, and communication with AP, AR, and banking partners. Question 7. What is working capital, and how does Treasury monitor it? Working capital is the capital tied up in day-to-day operations, usually current assets minus current liabilities. Treasury monitors it because movements in receivables, inventory, and payables directly affect cash. If DSO rises, collections are slowing. If inventory grows, cash is tied up in stock. If suppliers demand faster payment, liquidity tightens. I would track trends, compare against forecast, and partner with AR, AP, procurement, and operations to manage cash impact. In your answer, talk about current assets, current liabilities, receivables, payables, inventory, operating liquidity, key metrics, and Treasury's role in spotting pressure before it becomes a cash issue. Question 8. How would you explain liquidity risk? Liquidity risk is the risk that a company cannot meet its cash obligations when they come due, even if it is solvent on paper. It often comes from timing mismatches, unexpected outflows, weak collections, restricted cash, or reduced market access. To manage it, I would maintain cash visibility, build reliable forecasts, monitor covenant and facility availability, keep contingency funding options, and communicate risks early. Liquidity problems usually become serious when surprises are unmanaged. Be sure to mention the risk of being unable to meet obligations, timing mismatches, market stress, funding access, cash buffers, credit facilities, and why forecasting is central to mitigation. Question 9. What factors would you consider before investing excess cash? Excess cash should be invested based on safety first, liquidity second, and yield third. I would check the company's investment policy, approved instruments, maturity limits, counterparty limits, and credit rating requirements. I would also match investment maturities to forecasted cash needs, so operating liquidity is not trapped. Common options include money market funds, treasury bills, term deposits, or commercial paper. The goal is to earn return without compromising principal protection or access to cash. While answering, focus on safety, liquidity, yield, investment policy limits, maturity matching, counterparty risk, credit ratings, concentration limits, and ensuring cash remains available for operating needs. Question 10. How would you assess foreign exchange risk for a company? I would first identify where the company has currency exposure, foreign currency revenues, expenses, intercompany loans, vendor payments, or balance sheet items. Then I would separate transaction risk, which affects cash flows, from translation risk, which affects reporting. I would quantify net exposures by currency and timing, look for natural offsets, and consider hedges such as forwards, if policy allows. The key is aligning hedge decisions with forecast reliability, risk appetite, and accounting treatment. Make sure to cover transaction exposure, translation exposure, forecasted cash flows, currency mismatches, natural hedges, hedging instruments, hedge effectiveness, and coordination with accounting and operations. Question 11. What is interest rate risk, and how can Treasury manage it? Interest rate risk is the exposure to changes in rates that affect borrowing costs, investment income, or refinancing economics. For example, a company with floating rate debt will see interest expense rise when benchmark rates increase. Treasury manages this by analyzing debt maturity, fixed versus floating mix, sensitivity to rate moves, and available hedging tools. Depending on policy, swaps or caps can reduce volatility. The objective is not speculation, it is protecting cash flow and budget certainty. In your answer, talk about floating rate debt, investment yields, rate sensitivity, refinancing exposure, fixed versus variable mix, swaps, caps, scenario analysis, and impact on interest expense and cash flow. Question 12. How do debt covenants affect Treasury decisions? Debt covenants set boundaries that the company must operate within under its loan or bond agreements. They may include leverage ratios, interest coverage tests, minimum liquidity requirements, restricted payments, or limits on additional debt. Treasury needs to monitor covenant headroom because decisions like dividends, acquisitions, debt draws, or cash movements can have consequences. I would incorporate covenants into forecasts and reporting calendars to avoid breaches, protect lender confidence, and preserve access to funding. Be sure to mention financial covenants, negative covenants, leverage ratios, interest coverage, restricted payments, reporting deadlines, covenant headroom, forecasting, and the importance of avoiding technical default. Question 13. What controls are important in Treasury payments and bank account management? Treasury handles high-value and high-risk transactions, so controls are critical. I would expect clear segregation between payment initiation, approval, and release. Bank mandates should be current, user access should be reviewed regularly, and payments should require dual authorization based on thresholds. Reconciliations, audit trails, callback procedures for bank detail changes, and secure file transmission also matter. Good controls reduce fraud risk while still allowing the business to move cash efficiently. While answering, focus on segregation of duties, approval workflows, bank mandate controls, dual authorization, fraud prevention, account reconciliation, user access reviews, audit trails, and secure payment processes. Question 14. How would you investigate a cash forecast variance? I would start by comparing actual cash movements against forecast by category, such as customer receipts, vendor payments, payroll, taxes, debt, and CapEx. Then, I would determine whether the variance is timing-related or permanent. For example, a large customer payment may have slipped by 3 days, while an unplanned tax payment may be a true miss. I would speak with the relevant teams, update assumptions, document the driver, and feed the learning into the next forecast. Make sure to cover comparing actuals to forecast, isolating timing versus permanent variances, reviewing major inflows and outflows, speaking with business owners, updating assumptions, and improving future forecast accuracy. Question 15. What Treasury systems and Excel skills would you use in this role? I would expect to use a treasury management system or bank portals for balances, payments, and reporting, plus ERP data for AP, AR, and accounting inputs. In Excel, I would rely on pivots, XLOOKUP or index match, SUMIFs, Power Query, scenario tabs, and clean reconciliation checks. The technical skill matters, but so does control. Clear assumptions, version control, audit trails, and formulas that another person can review and trust. In your answer, talk about treasury management systems, bank portals, ERP data, cash reporting, reconciliations, formulas, pivots, lookups, scenario analysis, data accuracy, automation, and controls around spreadsheet use. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.